Hey everyone, and welcome back to Blueprint to Escape. Today, we're pulling back the curtain for a complete, transparent breakdown of our January 2026 income portfolio. We're not just going to show you what we hold, we're going to walk you through the exact moves we made this past month, and, most importantly, the core philosophy that drives every single decision we make.
Okay, before we jump in, we've got to do our standard disclaimer. Just remember, this case study is for educational and entertainment purposes only. It is definitely not financial, tax, or investment advice.
And just so you know, none of the companies or ETFs we talk about are sponsors. They're simply things we've been researching for our own portfolio.
And here's the most important part. Always do your own research. Every single investment decision you make has to be based on your own personal situation. Okay, with the formalities out of the way, let's get into the good stuff.
So this is the number that really anchors this month's case study. As of mid-January 2026, our portfolio is yielding right around 14%. Now, I want to be clear, this isn't some pie-in-the-sky, high-risk number. This is the target we aim for, and it's absolutely achievable with a sound, balanced investment philosophy, which we're about to show you. You know, some portfolios might boast even higher yields, but there's a strong chance they're losing capital along the way. Our whole strategy is about striking that perfect balance between generating strong income and protecting our initial investment.
So here's our game plan for today. We're going to start by opening up the portfolio so you can see every single holding. Then we'll dive into the recent moves, what we sold, what we bought, and exactly why. After that, we'll zoom out and look at the core philosophy that guides everything. And we'll wrap it all up with our action plan for next month. Let's get started.
All right, let's get right into the portfolio holdings. What follows is a completely transparent look at our Canadian and U.S. investments as they stand right now in January.
First up, let's take a look at the 30,000-foot view. As you can see, the portfolio is heavily weighted towards Canada, at about 80%, with the other 20% in the US. And this isn't by accident. It's a very deliberate allocation, partly driven by the tax advantages of holding certain assets in specific accounts, like TFSAs versus RSRPs, which you're about to see.
So, diving into the Canadian side, these holdings are mostly sitting in tax-sheltered accounts like the TFSA. Our cornerstone position here is HYLD at about 16%. But what probably jumps out at you are the really high yielders like HIJS and HBTE, both clocking in over 25%. And don't worry, we're definitely going to circle back to HBTE later on because there's a really important story there. This part of the portfolio is really our primary income engine.
Now for the US side, which we hold inside our retirement accounts, or RRSPs, this is where you can really see our strategy of blending growth and income come to life. I mean, look at this. We have a pure growth stock like Google, which has a 0% yield, sitting right alongside powerful income machines like QQQI. This whole section of the portfolio is designed to deliver both that long-term capital growth and consistent cash flow.
Okay, so you've seen the what, now let's get into the why. This next section is all about breaking down the key moves we made this past month and the strategic thinking behind every single one. Here's a quick snapshot of what happened. We sold off our positions in RPF, GoJ, and TRIN. On the other side of the ledger, we started a brand new position in HEI, and we kept adding to our long-term growth holding in Google, or Google L. Now let's unpack the reasoning for each of these. So none of these moves were random. We sold RPF simply to lock in our profits. Its price had a great run, which pushed the yield down, so it was time to cash in. We sold GOGY, which is a covered call ETF on Google, to cut back on risk. Now, a covered call ETF basically trades away future growth for immediate income. And while we love Google, having a leveraged income product on a single stock is just a bit more concentrated risk than we're comfortable with. So we replaced it with ECHI, which uses a similar strategy but spreads that risk across more than 10 different stocks. Much better. And finally, selling TRIN was just simple housekeeping. We already had exposure to it through other funds, so it was redundant.
And that brings us to a really important question, and it's one we want to be completely transparent about. Why on earth would we hold on to a position that's currently showing a loss on paper? This is where our philosophy really gets put to the test.
Let's use HBTE as a perfect case study. This ETF holds some very volatile tech stocks. A lot of them have what's called a high beta. Beta is just a fancy way of saying how much a stock's price swings compared to the market. Well, that volatility has led to a paper loss for us. So why are we holding on? It all comes down to a core principle: capital preservation. If we sell now, we turn a temporary paper loss into a very permanent, real loss. So instead, the plan is to be patient, keep collecting that fantastic income distribution it pays out, and slowly, gradually trim the position as its price recovers. It's a textbook example of sticking to your strategy, even when it's uncomfortable.
You see, that decision to hold HPT wasn't just some random choice. It's a direct result of our core investment philosophy. So let's zoom out for a second and look at the fundamental principles that really guide every single move we make.
Our philosophy really rests on a few key pillars. The first one, and the most important one, is capital preservation. Rule number 1 is simple: don't lose the money. Second, we focus on total return, not just chasing a high yield. Third, we maintain a balanced allocation, making sure no single holding ever becomes more than 15% of the portfolio. And fourth, we actively avoid what we call worsification, the danger of owning way too many things. For us, that sweet spot is somewhere between 23 and 25 holdings.
Let's just double-click on total return for a second, because this concept is absolutely critical. Total return is the combination of your capital's place going up plus the income it's kicking out. I mean, think about it. A 20% yield means absolutely nothing if the value of your initial investment drops by 25%. You've actually lost money. This focus on total return is what keeps the portfolio healthy and growing for the long term.
And that leads us perfectly into this idea of worsification. It's such a common mistake, this idea that owning more and more is always better or safer. When you over-diversify, you can dilute your returns so much that even your best ideas have no real impact, and your portfolio just becomes this sprawling, unmanageable mess. Staying focused is absolutely key.
All right, moving on to our next set of principles. We only invest with conviction, which means we deeply understand every single thing we own. We reinvest all our income, because that's how you let the magic of compounding do its work. We believe your portfolio has to be perfectly matched to your personal goals and your age. And finally, we do our best to stay stoic, which really just means avoiding emotional decisions and the fool's errand of trying to time the market.
So that's the philosophy that got us here. But as you know, investing is always about looking forward. So here's our actionable game plan for the month of February.
For February, we've got 3 main things on our radar. First, we're going to continue that patient, gradual reduction of our HBTE position as market conditions allow. Second, we're going to be doing some deep research into Latin American markets, specifically looking at ETFs like EWZ for Brazil and ILF for the broader region. And third, we're exploring adding some more defensive sectors like healthcare or REITs, and we've got our eye on ETFs like MREL here in Canada for that.
And that brings us to you. We've shown you our entire hand, and now we'd love to hear from you. What are some of your favorite income ETFs or strategies that you're looking at for 2026? Please jump into the comments section below and share your thoughts. We read every single one.
And hey, if you appreciate this level of transparency and you want to follow our journey to financial independence month by month, make sure you hit that subscribe button. We release a full portfolio update just like this one every single month.
So, to wrap things up, if this case study was valuable to you, please do us a favor and hit the like button. It really helps the channel out. Remember to subscribe so you don't miss our portfolio releases, which always come out around the 20th of each month. And please keep the conversation going in the comments. We are here to build a community that's all about achieving financial independence, building passive income, early retirement, and designing the life you actually want to live. Thanks so much for watching.